Welcome to this explainer. Today we're diving right into the May 9th, 2026 Convergence Brief. It's kind of like playing financial detective, honestly. We're going to see exactly how this brief builds on two absolute analytical powerhouses, the Polymarket Macro Monitor and the Real-Time Weekly Report, to, uncover the hidden currents of today's market and hunt down some actionable swing setups. Before we really get going, I do need to read the mandatory legal disclaimer you see on screen. The content presented in this explainer is intended solely for general informational and educational purposes. Nothing herein constitutes or should be construed as financial, investment, legal, or tax advice. You should not act or rely on any information in this explainer without seeking the advice of a qualified financial professional. This audio/video explainer is an AI-generated product, produced using Notebook LM. It automatically summarizes and synthesizes reports, analyses, and commentary originally published at reflectionsofreality.substack.com. All views, opinions, and analysis expressed are those of the original author and do not represent the views of any financial institution or regulator. Past performance is not indicative of future results. All investments involve risk, including possible loss of principal. Copyright Reflections of Reality, all original content rights reserved.
All right, with that out of the way, as I just mentioned, this explainer automatically synthesizes the incredibly deep, proprietary research originally published at Reflections of Reality. If you want to dig into the raw data and original reports yourself, I highly recommend it. Just head over to the URL right there on your screen, reflectionsofreality.substack.com. Okay, let's look at our roadmap. We're covering the health price paradox, lens 1, which is Polymarket, lens 2, which is the tape, the convergence verdict, the rotation map, and finally, swing prescriptions. Let's get to it. Section 1, the health price paradox. So, we've got a really glaring contrast staring us in the face right now. On the surface, the S&P 500 is just absolutely crushing it, printing record highs near 7,400. But if you look beneath the hood, medium-term market health is actually fracturing. It's falling to 43.7%. Price is completely outrunning breadth. And you know what that means, right? It's the classic signature of a late-cycle, heavily concentrated rally. To figure out why the headline index looks totally bulletproof while the foundation is literally cracking, we're going to need our two detectives.
Which brings us to Section 2, Lens 1, Polymarket Probabilities. All right, so to solve this paradox, our first detective is the Polymarket Macro Monitor. This lens looks at prediction markets to basically forecast regime-defining events weeks before they even happen. And the absolute loudest signal here, an 80.5% probability that NVIDIA remains the largest company by the end of June. That is huge. It clearly illustrates that the AI infrastructure supercycle is completely intact. There's no demand cliff in sight. The market is validating that massive $3 trillion plus valuation through the earnings cycle. Really, this single probability explains exactly why the S&P is hitting those record highs. It's being structurally anchored by this giant capex arms race in artificial intelligence. But zooming out and looking impartially at the broader environment, prediction markets are pricing in some serious complexity. First, there's a 77.5% chance of a Democratic House. That basically prices in legislative gridlock, which historically caps deficit spending and removes wealth tax risks, which is actually a bullish setup for equity multiples. However, we're also looking at a 74.5% chance that the Strait of Hormuz disruption persists. Listen, this isn't just a blip, it's a structural energy shock keeping real volatility elevated. And then, wow, look at the Fed. Prediction markets see a resolutely hawkish Federal Reserve with only a tiny 1.6% chance of a June cut. The Fed is anchoring hard on inflation, think Volcker not Greenspan, and they are completely refusing to ease into this supply shock. Let's move to Section 3. Lens 2, the weekly tape. So that's the prediction market side. Now, we cross-reference those predictions with our second detective, the weekly report, which reads the actual real-time market tape. What's institutional money actually doing right now? Well, the tape shows a reflation regime surging to nearly 82%. Cyclical growth and inflationary themes are totally dominating. We're also seeing the market dashboard index at 62.8, which puts us in a bullish kickoff zone, historically a great spot for risk-adjusted upside. But here is the catch. Liquidation velocity is increasing, up 7.3 points to 14.5%. And there it is. That's the tape confirming our paradox. While the index climbs on reflation and AI, institutional profit-taking is accelerating right beneath the surface. It's a massive internal fracture. On to Section 4, the convergence verdict. Okay, so the crucial step here is finding exactly where these two lenses align. Where does the predictive polymarket agree with the real-time tape?
Because the gap between them, that's exactly where swing risk lives. And honestly, they agree on almost everything. Both lenses confirm the hawkish Fed, the intact AI supercycle doing all the heavy lifting, and the eroding breadth caused by geopolitical and energy stress. But look at where they disagree. The prediction market says the Fed won't cut, which means long-term bonds should be taking a beating. Yet, the real-time tape shows long-duration treasuries actually catching a bid. Why? Well, the brief concludes this isn't about on the Fed blinking. Nope, it's a flight to quality tail risk hedge. Institutions are buying bonds as a shield against that persistent Middle East disruption we talked about earlier.
Next up, Section 5, the rotation map.
This brilliantly illustrates how that convergence verdict is already actively playing out. Looking at the ETF quadrant map, we can see exactly where the money is flowing to reflect this regime shift. Real assets and safe havens, think gold, silver, biotech, they're sitting happily in accumulation. This perfectly aligns with our reflation surge and that Hormuz risk premium. Meanwhile, rate-sensitive tech, momentum unwinds, and utilities, they're being actively rotated out or just entirely liquidated. The market is already punishing sectors that simply can't survive a hawkish Fed combined with an energy shock.
Finally, Section 6, swing prescriptions. So how do we actually trade this convergence? Your swing prescription here is super clear and completely data-driven. In the green category, we let aligned winners breathe. NVIDIA is the absolute cleanest hold here, sitting right at the intersection of the AI supercycle and the reflation regime. SPY is also a solid hold, based on positive alignment. Now, in yellow, we protect contested names. Amazon and Costco have strong fundamentals, sure, but the tape shows institutional flows are starting to exit, so we want to aggressively raise our stops there. And in red, we execute disciplined exits. Microsoft's AI premium is compressing due to fragmented competition. Taiwan Semiconductor carries a silent geopolitical tail risk that the tape is already punishing. And Walmart is facing margin squeezes in this reflationary environment. The rule of thumb, if a stock is fighting both the prediction markets and the real-time tape, you exit.
All right, as we wrap up this explainer, I want to leave you with one final thought. The tape is screaming that the AI supercycle is very real, but its benefits are incredibly, almost dangerously narrowly distributed. If this market is being carried by just a handful of giants while breadth silently deteriorates right under our noses, ask yourself, is your portfolio actually prepared for the inevitable concentration unwind when it finally happens? Thanks for tuning in to this breakdown of the Convergence Brief. Stay focused and keep letting the data guide your decisions.